Evan McGowan.
I'm Andreya.
And we're doing our accounting project, the skit one.
Obviously.
And we're doing the accounting formula. Hi, I'm McGowan.
No.
The accounting equation is 3 sections. Permanent accounts, first with asset, which equals liabilities plus owner's equity. Yay!
Stop. Oh. Stop recording. Oh. So assets are like your cash in bank and like your equipment. Yeah, so that's like all the like, and accounts receivable. That's like basically like all the business stuff, you know, like all of your like, excuse me, I didn't know there was a clown here. What was the next one?
Liabilities.
Liabilities. This is the stuff that costs a lot of money. This is the stuff that takes, it's not, what was, so liabilities, like liabilities, that would be like your accounts payable, your withdrawals. So liabilities are our accounts payable, you know, any sort of way that we get our money back, or like they pay us from accounts and what have you. Okay, owner's equity. This is basically capital, your withdrawals, anything that sort of has to do with like your main source of like money from your bank and the business, you know. Onto our temporary accounts, which are expense, withdrawal, and revenue.
The first temporary account is expense. Expense is like the things that you have to buy for your business to keep running, like the utility expense, advertising expenses to promote your business, and stuff like that. Withdrawals when the person who owns the business takes money for like personal uses or transactions outside the business. Then the last one is revenue. That's when like you get money, like from your service that you provide. You get money in payment. That kid just got. Okay, so now we're gonna explain the 3 different types of papers that you put the account information on and the transactions. The first one is the general journal. To fill this out, you put the date first, the 2025, and then you put the month and the day, but you only put the month once. And then you list what account is affected by the transaction made. The one that affects the debit column is first, and the one that affects the credit column is second. And each account, if it's a different account, you indent and you put what kind of payment being made, or like the receipt, invoice, or check, and stuff like that.
Memorandum.
Period. On the bottom line to show. And you put the account number where it says post ref. That's the general journal.
So, on to the next one, which is the general
Ledger.
So this one is really close to the general journal, except we break apart the specific accounts. So as you can see, cash and bank is here, accounts receivable, computer equipment, yada yada yada. You get the gist. Basically, this is just putting all of the, I guess you could say, purchase history into one sort of like column, just to make it a little bit more organized. Most of the stuff is the same on the journal. It's the same like on here. Like we have post reference, the year first, month second, but only wrote once, and then the dates right there. The only thing that is different is, what is that called?
Normal balances.
The normal balances with all of the
Transactions.
Transactions added together.
In the same column.
Yeah.
This one is the last step of the process. It's called the worksheet. On the top, you write the name of your business and the worksheet, and then the date that all the transactions like ended or the time period. In the first column, you write the account number to keep it organized. Then you write the account name, Then you find the trial balance, which you found in the other two papers. Put them right here in order. You add them up, make sure they're equal. If they don't equal, something's
You did
wrong.
it wrong. You did
Redo
it wrong.
it.
Redo the whole thing.
Redo the math, bruh.
Exactly.
Then the income statement is only the revenue and expense accounts, nothing else. And then you add those up, and whichever side is higher depends if you have net gain or net income. It's the same thing. Cut this part out. Okay.
Okay.
Okay, the last column of this worksheet is the balance sheet. This one is everything else. Woo.
I'm pretty sure you can guess what the balance sheet is.
Assets, like everything.
Assets,
Liabilities, owner's equity, and withdrawal. Don't forget your withdrawal.
Dude, I almost forgot. I'm being serious.
Okay. You have to remember withdrawal because then they won't equal.
That's bad if they don't equal. That means you messed up.
At this side, whichever side's higher, you subtract the difference from the smaller gap to make sure they're equal. If none of these equal, something's
You messed up.
Que pasa? And if you do make a mistake, don't cross it out. Don't erase it. Don't erase it.
Cross
Looks
it out.
suspicious.
Yeah, it'll look bad. You have to cross it out and put the correct information on top.
And make sure your calculator and your mental calculator are great.
Yay.
And that's how you do accounting.
Yay! That's the basics of accounting. What does any of this mean?
You know what the formula is? Right there. Oh. Assets equal liabilities equal plus.
Oh, yeah. Plus.
Owner's equity, which in other words is capital.
Oh, exactly.
Exactly.
Oh, you can go.
And those are permanent accounts.
Yep.
The temporary accounts under capital are expense,
Yep.
withdrawal, revenue, etc.